You know the old saying, right? Never kill the golden goose that lays the eggs? Well, for years, the Indian equity market was exactly that, a golden goose for foreign investors. It offered this historic, seemingly unstoppable bull run, totally fueled by rapid economic expansion and a really welcoming investment climate. But recently, something shifted. A sudden combination of aggressive domestic policy changes and massive global tech trends has completely disrupted this long-standing paradigm. The golden goose hasn't necessarily been killed, but it's definitely being squeezed, and investors are reacting exactly how you'd expect.
2.4 lakh crore rupees. I mean, just think about that for a second. That is over 28 billion US dollars. We're talking about an absolutely unprecedented amount of foreign capital pulled straight out of Indian secondary markets in the year 2025 alone. And this wasn't just some brief knee-jerk panic. It was a sustained structural exit that has continued bleeding right into 2026.
So, welcome to this explainer. Today, we're diving deep into the anatomy of this historic market shift. We're going to decode the exact macroeconomic triggers and the global catalysts that caused foreign institutional investors to just pack up their capital and leave. If you really want to understand the modern evolution of India's capital markets, you are in the right place.
Section 1. Killing the Golden Goose. The resilient economy versus the great sell-off.
Now, there's a massive disconnect happening here. India's GDP is clipping along at a solid 6.5%. Inflation is cooling, yet foreign capital is bolting for the exit. So you're probably wondering, why hasn't the market completely collapsed? Well, while foreign investors pulled out over 2.4 lakh crore in 2025, domestic institutional investors actually poured in a whopping 5.3 lakh crore. This was entirely driven by massive retail SIPs, regular, systematic monthly investments by everyday citizens. That domestic liquidity acted as a structural floor, totally saving the market from a devastating crash. But of course, it doesn't solve the underlying problem of why the foreign capital is fleeing in the first place.
Section 2. The double tax dilemma, self-inflicted wounds on investor yields.
To really understand this foreign exodus, we have to look at the core domestic issue. The absolute heart of the frustration lies in what investors are calling the double tax dilemma. See, when the Securities Transaction Tax, or STT, was introduced back in 2004, the whole idea was to create a frictionless way to collect tax at the transaction level, with the goal of eventually replacing capital gains taxes entirely. Fast forward to today, and investors face a compounding burden. They're forced to pay overlapping STTs every single time they trade, alongside heavy realization-based capital gains taxes when they actually make a profit. It is a double whammy, and it directly eats into their margins.
And then we get to the tax hikes, which aggressively stripped away net real returns. Short-term capital gains jumped from 15% to 20%. Long-term capital gains went up from 10% to 12.5%, and they even stripped away crucial indexation benefits. Add in massive hikes on futures and options transaction taxes, pair all of that with a depreciating rupee, and the net real return for a US dollar-denominated investor completely collapses. For multi-asset allocators, the math simply stopped making sense.
But honestly, taxes were just one part of the friction. Foreign funds also got hit with severe regulatory hurdles. In late 2024, SEBI, India's market regulator, enforced stringent new disclosure rules, demanding that highly concentrated foreign funds identify their ultimate beneficial owners, or literally face license cancellation. On top of that, a landmark Supreme Court ruling involving Tiger Global totally shattered the legal safety of legacy offshore structures. The court ruled that tax authorities can actually investigate the true commercial substance of Mauritius-based entities, denying them legacy treaty benefits. This created immense legal uncertainty and prompted a lot of funds to just say, you know what, let's liquidate and leave.
Section 3. The emerging market contrast. Money doesn't evaporate, it relocates.
Because here's the thing, foreign capital didn't just vanish into thin air. It strategically relocated to more favorable Asian markets, and valuations played a massive role in that. The contrast in price-to-earnings ratios is pretty stark. India was trading at a highly expensive premium of 22.7 times forward earnings. Meanwhile, you had markets like China trading at 16 times, and Indonesia sitting at 11.2 times. When India's corporate earnings growth started to slow down, this huge valuation gap triggered a massive sell India, buy China rotation among global emerging market funds. They were simply looking for cheaper entry points.
But it's not just about how expensive the stocks are, right? It's about what those stocks actually do. If we contrast India's index composition with East Asia, the divide is glaring. India's benchmarks are heavily reliant on domestic consumption, financials, and traditional IT services.
East Asia, on the other hand, boasts a highly concentrated, advanced hardware and semiconductor fabrication ecosystem. And in the current economic climate, that difference is literally everything.
Section 4. The missing AI catalyst. The global supercycle passes by.
Which brings us to the icing on the cake, the ultimate structural blow to the Indian bull thesis, the global AI supercycle. We noted earlier that global funds pulled almost $24 billion out of Indian equities in a really short span. We have to ask this crucial question. Where exactly did that money go? Because understanding where it went tells us exactly what global investors are prioritizing right now.
So the crucial takeaway here is that India possesses a severe tech deficit. The country simply lacks the advanced semiconductor fabrication and hardware manufacturing plays that global funds are desperately chasing. To make matters worse, India's traditional IT outsourcing services are perceived by global markets as highly vulnerable to AI-driven automation. Global funds didn't want to hold vulnerable software services, they wanted to maximize their positions in the physical infrastructure powering artificial intelligence.
That pursuit of AI infrastructure leads us to an absolutely massive figure. $4.95 trillion. That became the total market capitalization of Taiwan's stock market in 2026. Driven almost entirely by the relentless, incredible rally in Taiwan Semiconductor Manufacturing Company, this staggering surge officially allowed Taiwan to dethrone India as the world's fifth largest stock market.
And the resulting 2026 benchmark equity performance in US dollar terms? It is undeniable. South Korea skyrocketed by 62%, fueled purely by the demand for high-bandwidth memory chips. Taiwan surged 40%. Meanwhile, India's index actually contracted by 14%. Essentially, consumption-heavy markets like India are being used as funding sources, piggy banks really, to go out and buy more chips.
So to summarize the core takeaway of our explainer today, the global investment narrative has fundamentally shifted. The long-standing paradigm of India's demographic and consumption growth story has been, at least temporarily, eclipsed by the sheer gravity of artificial intelligence hardware. Right now, global capital is rewarding economies strictly based on their physical position within the AI infrastructure value chain.
Which leaves us with one final, very provocative question. As long as this AI supercycle dominates, is India's market doomed to be just a tactical, short-term play for foreign investors? Or can the golden goose actually be revived? It's likely going to require a serious combination of valuation resets, strong corporate earnings growth, and perhaps a complete rethink of those heavy double tax policies to reignite true strategic foreign interest. Until then, it's the domestic Indian investor keeping the floor from falling out. Thanks so much for joining me on this explainer. Keep learning, and I'll catch you next time.